So we're here with Barry Ritholtz, founder and chief investment officer of Ritholtz Wealth Management, also Bloomberg contributing editor or columnist for Bloomberg View and host of Masters in Business, the iconic business podcast for Bloomberg. So let's kick it off. Yesterday, finally feels like the markets are showing us that they are in fact cyclical. Give us some background, your view on what is happening in the markets.
Sure. 2017 was an unusual year. We had extremely low market volatility. We had crazy high political volatility, but that's a whole nother conversation. We had very, very few days where the market was up more than 1% or down more than 1%. Very, very unusual for a year to have that little volatility. That all seemed to change at the end of January. Come February, everybody after the fact looks for a narrative explanation. I think the simplest explanation is markets just ran too far too fast on investor enthusiasm for the tax cuts, for global economic growth, for profits. But just to put this into context, the past 4 months the markets ran 14%. A good year on average for the past century is 8 to 10%. So when you're up better than 50% more than an average year in a third of a year, that just means you have to eventually come back to more normal levels, and that's what this seems to be doing.
Isn't this just regression to the mean, that one
Absolutely.
out of 5 years we have a decline of 20% or more? So if we wake up at the end of 18 and the markets are at 20,000 or 18,000, wouldn't it just be, well, of course they are? I mean,
Yeah.
Isn't it stranger? Wouldn't it be a stranger case that the markets go to 30,000 versus 20,000 right now?
This is normality. Markets go up and down. That's what they're supposed to do. We usually see a couple of 5% pullbacks a year. We really didn't see that for a while. 10% pullbacks every other year. Haven't had that happen in quite a while either. So at a certain point, things just, I'll give you a perfect example. When you look at the long-term trend of the market, and that's driven by a lot of things like economic recovery, corporate profits, demographic changes, we got so far ahead of that trend line that if we simply just pull back to a normal trend line of growth, you could be at 20, 22,000 on the Dow, and that's normal. Two-sided markets are what they're supposed to do, up and down.
And you're obviously in the business of trying to identify alpha. If you look at the rest of the year, make the bull case, make the bear case.
I have no idea what's going to happen, and I never try and guess. I try and tease out what's really going on in the underneath the headlines, because if you understand where we are today, it gives you a much better sense of positioning yourself to where we're going to be in the future, as opposed to, I'm going to guess that Bitcoin will be fill in the blank, 15,000, 10,000, 5,000. Rather than do that, we look at, you mentioned mean regression, we look at long-term valuations, long-term trends of various asset classes. We know from all the academic literature, over long periods of time, value outperforms growth, small cap outperforms large cap. Having a diversified portfolio, including overseas holdings, reduces your risk for a US-centric event like we've seen this week. So rather than try and guess, hey, we're going to move our chips on the table like this and either be right or wrong, we kind of put a bear hug around the entire world asset classes and say, wherever the market goes, we will participate in the upside somewhere, but also recognizing we're also going to participate in the downside.
What asset class globally is undervalued right now?
So U.S. stocks are fully valued or expensive. When we look at Europe, they're cheaper or closer to fair value. I wouldn't say they're dirt cheap, but they're much cheaper than the U.S. or somewhat cheaper than the U.S. And then emerging markets, and by the way, we've been saying this now for about 2 years, emerging markets are by and large the cheapest.
So potentially underweight U.S. stocks, overweight emerging markets and Europe. When you walked in here this morning, you talked about how average investors underperform not only the markets, but their portfolio.
It's a fascinating data point. So people, to alpha and beta. Beta is what the market gives you. Alpha is that outperformance, which is exceedingly rare and very difficult to do over extended periods of time. Some people say impossible.
Stock picking.
Stock picking, market timing, complex hedging. There's a whole bunch of different ways that it could be done. And the people who do it are the all-stars. The problem is that it's not that that skill deteriorates, it's that whatever that unique skill is, markets kind of figure it out.
Starched out. It gets
right,
carved out.
Exactly. And so a lot of people have decided we're not going to chase alpha, we're going to accept the beta. Because what we've seen over time is as you try and outperform the market, you often end up not only not outperforming, but missing the beta and underperforming. In fact, huge swaths of active managers underperform, and that's before we get into expensive fees. That has resulted in BlackRock being $6 trillion, Vanguard being $5 trillion of assets. These are the big indexers. And so people are starting, mom and pop are starting to wise up to the fact that, hey, you know, if I just own a broad portfolio of global assets and low-cost funds or ETFs, and I rebalance once a year and I take what the global market gives me, that's probably going to outperform what 90% of my peers are doing. People have figured this out, but only a small, I would say about 20% of the investing public has figured that out.
So hedge funds underperforming the S&P by the amount of their fees. Plus some. And then we've seen an enormous reallocation of capital out of active management into passive, the BlackRocks, the Vanguards, low cost, ETFs. It seems like everyone's onto that now. Does that mean potentially we're about to enter another great era of stock picking as volatility picks up and you have to actually find value places?
There's no doubt that as more and more people move to passive, it creates an opportunity for true active managers. Bill Miller, who had the streak that lasted 15 years of outperforming the market every year, has pointed out that what is purported to be active management is really closet indexers, people hugging the benchmark. Hey, you don't get fired for just doing a little better or a little worse than the market. What you really, if you want to participate on the active side, you want to find managers who have what's described as large active share, meaning their portfolios differ significantly from what the benchmark is, and you're either going to win a lot or lose a lot with that strategy, but you're not going to pay up for somebody who's essentially giving you benchmark returns. And that's a different thought process because it reflects a reality that most people really don't want to believe, but it's true. If you want potential upside, you must be willing to accept potential downside. Risk is a two-sided coin, as investors have learned over the past week.
But you've said there's a certain behavioral, economic, that the brain is actually a little bit, or our emotions, I should say, is an enemy. And say more about that we tend to, the reason we underperform our assets and in the marketplace is emotional knee-jerk or gag reflex.
So there's a study done every year by Dalbar that looks at average investor returns, and some of the things they've discovered is there's a tendency for investors, and this is starting to attenuate a little bit. We saw a ton of it in the 90s, but it still exists today. People are attracted by bright, shiny objects. And so when you have a fund manager who's shooting the lights out that month, that quarter, maybe even that year, they go on TV, they get the magazine cover, all of a sudden they're a hot name. Money just pours into their funds after it's had this giant run-up. That's probably the worst time to buy something. When you want to buy it is after it's had a horrific sell-off, but the process is still valid. So people confuse outcomes with process. It's very difficult to separate skill from luck. And very often when people are chasing some of these look at Bitcoin as a perfect example. If you own it at 5 cents or $5 or even $500, hey, that's a fantastic trade. You've done well. But everybody who piled into this speculative, I don't know, currency, technology, I don't know what you want to call it, at 12,000, 15,000, 19,000, you know, you're just rolling the dice. This morning it was trading under $6,000. And that still seems like a pretty rich number. But we don't tend to go out and hunt these things when they're unappealing and low value. We tend to chase the hot new thing. And Bitcoin is a perfect example of how, there was an article in the Washington Post, Bitcoin is my retirement plan. Really? You're going to be eating cat food. That's a horrible idea. Maybe it works out, maybe it doesn't, but you might as well go to Vegas. It's the same sort of speculative risk. And the tendency that people have is to not make investments. We're very bad at conceptualizing the long run. like 30 years from now, what happened on a given Monday in the market is going to be pretty irrelevant. But how you maintain your portfolio and how you think about risk is what's going to determine your outcome. The other thing we all tend to do, it's very easy to get caught up in all the flashing lights and noises. And, you know, CNBC and Bloomberg has the screens with all these things going on.
Yeah.
It's a video game. I don't remember who I'm stealing this quote from, but the expression, stocks really get in the way of your long-term investing, says a lot about how we behave as humans.
So you're a wealth manager. I'm going to give you a couple scenarios, and you tell me how you would, loosely speaking, allocate their funds. I'm a 25-year-old making a good living in New York. Any of these people who can save a few $1,000s a year, maybe 3,000, 5,000, and starting to think about, hopefully long-term, what do they do? Just an ETF? What do they do? Obviously, they can incur more risk than most of us. What do they do?
So they should be 100% equity portfolio.
100%.
They should be rooting for a stock market crash, because if markets fall 20, 30, 40, 50%, and they're looking out 50 years, 25-year-olds are going to be retiring 50, 60 years from now. They're not. It's not 55 or 68 now.
All equities, low cost.
For today, right. Global portfolio, they could do a bunch of 4 or 5 low-cost ETFs. You have U.S., you have overseas, Europe, you have emerging markets. If they want to own a tech fund because they relate to technology, why not? It's certainly something you could do. More volatility, but it doesn't matter. When they turn 50, they might want to shift that to 80% equities, 20% bonds. What that does is give them a little ballast when the market goes up and down, and now they're closer to retirement and they don't want to think about, gee, a 30% drop is really a lot of money. And as they get older, they move more towards a traditional 60-40 portfolio. But the old rule of you take your age minus 100, whatever, and that's how much bonds you should have is out the window. When you're young, you can have a lot of risk as long as you don't allow your emotions to get in the way. I can't tell you how many people in the spring of 2009, after holding on through a 57% collapse in equity prices, finally threw in the towel and said, I can't take any more, I'm out. And that pretty much is how crash bottoms get made.
27, coming out of business school, you are thinking about financial services, thinking about media, thinking about tech. You're just an economic animal. You, like most 27-year-olds, you're not entirely sure what you want to do with your life, but you know you want financial security or you want to ride an upswing. Which sector do you think holds the most promise for?
So I'm not looking to duck the question. I want to give you a fuller answer. I think you need to do 3 things as a recent graduate. You have to understand that you're a free agent. There's no longer, and I think everybody of that age understands that. But that means you need to build your brand, and that's a combination of media and social and self-awareness. If you don't understand the basics of coding, if you can't do, if you can't build a basic website, if you can't work with Excel, you're at an enormous disadvantage from your peers. And then finance, I'll tell you, you run a company, I run a company, we're not even 5 years old. That has been an immense learning curve in everything from compliance to payroll to legal to accounting. If you're coming out of business school, you should understand the details of running a business, because your life is really going to be your business. And whether or not it has an LLC or an S Corp at the end of it, having those financial skills and having those social, technology, and media skills are an important part of your future success. You're a perfect example. I guess I'm a perfect example. Understanding finance, understanding media, understanding technology goes a long way to getting to you as a future employee or entrepreneur. And without all 3 of those skills, you're really at an enormous disadvantage.
So a series of questions. Try to bring down all screens and just go with your gut in terms of an answer, recognizing none of us have a crystal ball. End of 18, markets higher or lower?
Slightly higher.
Cryptocurrency, Bitcoin, $6,000 now. Above 10, less than 1,000. Which do you think is, no, let's say above 20,000, less than 1,000. Which do you think is more likely?
I would bet less than 1,000.
Less than 1,000. ICOs, a new means of financing small companies, or fraud?
Well, there's been a lot of fraud in it so far, so saying fraud isn't a big leap. There's an issue with IPOs and how few companies are coming public. That needs to be tweaked a little bit.
ICOs going away or going to be a source of financing for small companies?
The recent history suggests that they're not long for the world.
That ICO.
Unless there's a major change.
Got it.
You know, it's a viper's nest of
2017, more money raised in ICOs and
than
allocated in
IPOs.
venture capital.
Yeah, that's amazing.
And it's crazy. A first $1 trillion company.
A year ago, I would have said Apple. Now I'm leaning towards Amazon.
A company that's going to be the poster child for this bubble. One or two stocks that you think could just go down 80%.
I'm waiting for Sears to go out of business.
Well, okay, that's.
I've been waiting for Sears to go.
That's really kicking a horse off.
Can I tell you? I waited 8 years for Blockbuster to go out of business.
Well, things die usually slower than they're supposed to.
Much slower. It's amazing. I think I don't know when it happens, but I kind of think Facebook becomes the next MySpace.
Really? You think Facebook could be MySpace? Any others that you think could go down 80%? And we'd say, well, of course it did.
I won't be surprised to see some company get cut in half.
Yeah, on a scandal.
Yeah, on a sexual assault, sexual harassment scandal. What's shocking to me about Fox News is how long that went on without anybody finding out about it, and they're a public company.
I mean, that might have led to the sale, right? That could have been, he could have.
It certainly was a factor. We better hit that bid while there's still a bid to hit, for sure.
So you're doing podcasts. What do you see in terms of your own experience with that medium, podcasts?
That's been the most fun I have every week. It's absolutely fascinating. Not only do I get to sit with people like you, which is really interesting, but you get to hear from people. That's one of the ways I've worked out of my own bubble. I brought in Jeb Bush's campaign manager, the guy Mike Murphy, who ran his PAC, Right to Rise. Bruce Bartlett was a Reagan appointee, and although he's an interesting guy because he's a lifelong conservative, but tapped out under Bush and basically said the Republicans have lost their mind. I try and find people from outside of just finance. But
the medium's taking off. My sense of podcast is one of the few kind of mediums in media that is really on a hockey stick.
So here's the little secret that everybody in finance ignores, at least in financial media. Who wants to sit on a couch and watch financial television? What's your favorite stock? What's the Fed going to do? Where's the Dow going to be? Coming up after the next commercial is pretty heinous. On the other hand, the opportunity to take a deep dive with somebody who is clearly successful, has something to say, is thoughtful, educated, and intelligent, and is willing to give you an hour or an hour and a half, that's unbelievable. The podcast started, the reason I created Masters in Business was because someone who I was fascinated by would show up on a financial television show. They would get their 6 minutes, give a few soundbite answers, and then they're off to the next one. I'm like, no, bring that guy back for an hour and let him talk. What are you doing?
Thoughtful conversation.
And so that's Howard Marks, Ray Dalio, Bill Miller, Bill Gross, Jeff Gundlach. Go down the list of these people who are incredibly accomplished. Bill McNabb is now the chairman of Vanguard, was the former CEO. David Booth created Dimensional Funds Advice. Yeah, there's a run of people, I'm coming up on 200 now, that this show shouldn't exist because the producers of television should have figured this out decades ago. Instead, they seem to think they're covering a football game with the graphics and the sound effects and the in and out stuff. Investing is supposed to be over the long term, over decades. That fast stuff is not what you should be doing, at least in my opinion. And I think other people agree. Not just this has become the most downloaded podcast at Bloomberg, but also since I launched this, a dozen similar type podcasts have come out, some with a narrower focus on technology or value investing or whatever. And that's really fascinating. If it's not only the golden age of television, but it's the golden age of podcast and investing. If you want to learn about investing, I get emails all the time from business professors. Hey, I assigned 6 of your masters in business to my class for an assignment this year. I get stuff from people. I have to drive 2 hours each weekend, and I listen to a few of the podcasts on the way or back. Or just simply, hey, my treadmill sucks, and you make that 45 minutes go by faster.
Good stuff. Barry Ritholtz, founder and chief investment officer of Ritholtz Wealth Management. Thanks very much, Barry.
Thanks for having me, Scott.